Good afternoon, everyone, and thank you for joining the Bipartisan Policy Center for this webinar on the state of the U.S. housing market. My name is Dennis Shea, and I am the Executive Director of the J. Ronald Terwilliger Center for Housing Policy. The Terwilliger Center was founded to advance the goal of a decent, safe, and affordable home for every American family. The past 12 months have been momentous ones for the housing market. Last year, we saw rent increases as high as 30 to 40% in some communities. While rents continue to rise nationally, their rate of increase is slowing. Home prices have cooled since their peak in the late summer and fall, but remain higher than they were at the beginning of last year. With the Federal Reserve attempting to tame high inflation, mortgage rates continue to fluctuate. So what does this all mean for the housing market and perhaps more importantly for housing affordability? To help us make sense of this complicated picture, I'm pleased that we are joined today by two outstanding experts. Jeff Tucker is the senior economist for Zillow and a master of Zillow's industry-leading real estate database. His research interests include household formation, home ownership, and housing supply. Jeff, who received his master's degree in economics from the University of Washington, go Huskies, will break down those trends in more detail and explain what they mean for housing affordability going forward. And we had Jeff in September with us, and it's great to have you back, Jeff. Yelena.
It's great to be here.
Thanks for coming. Yelena Maleyev is an economist. Our second guest is an economist at KPMG. In addition to her knowledge of macroeconomics, Yelena has developed significant expertise in both housing and construction. Yelena received her master's degree in applied economics from Georgetown University. I'll say go Hoyas. And she will share her insights into the large-scale movements and trends in the U.S. housing market in both the for sale and rental sectors. We're going to kick off things with short presentations from both Jeff and Yelena before turning to Q&A. At any time, please feel free to add a comment or question in the chat if you're watching live on YouTube, or tweet at BPC_bipartisan. That's at BPC_bipartisan, or using hashtag BPC Live. So with that, let me turn it over to Jeff, who will start us off. Jeff?
Thank you, Dennis. Thanks to the Terwilliger Center at the Bipartisan Policy Center. And it's great to be back. This is a wonderful forum for discussing housing affordability, which really affects everyone around the country across party lines. So I'm going to jump in right away, really, to an overview of the wild ride that the housing market has been on in the last few years. As well as really the state of the market and where it looks to be heading as we go into the first several weeks of 2023. I've got kind of an executive summary right here. It was a roller coaster. It's been up and down, but really mostly up. Prices climbed at an extraordinary rate for 2 years, really from mid-2020 to mid-2022. But by this last summer, buyers hit an affordability ceiling. The 1-2 punch of those higher prices and higher mortgage rates meant that a lot of buyers just had to step away from the market. Then things cooled down really substantially over the last several months, but something that kind of stopped the price drops, this kind of insulation, this buffer, was the scarcity of listings. It's, I think, something Yelena and I are going to talk about a lot. Is just the lack of supply relative to demand for places to live in this country. Now the market seems to be normalizing, and if anyone was hoping that some kind of runaway price decline would restore affordability for everyone, those hopes have been dashed. You'll be waiting a long time if that's what you were hoping for. The rental market has also gotten much less affordable, and I've got some data on that. So just to give kind of the 30,000-foot view, this is the Zillow Home Value Index. It takes the typical home value around the country based off of this estimate, which is Zillow's estimate of what every home would sell for. That top line shows the surprising trajectory of home values, which are still up almost 2/5 from the same price level that they had on the eve of the pandemic 3 years ago. And you can also see that sort of tremendous year-over-year home price appreciation in the second panel, up in the double digits for over a year straight, at times up to 18 or 19% annual price appreciation. Those are numbers none of us ever thought we would see in the housing market. Maybe, growth stocks, maybe certain other assets in the economy, but housing, no way. We never thought we would see 18% price growth. And then finally, that kind of the month over month jitters in the final panel show how they show how prices actually did fall in the second half of last year. Like I said, buyers struggled with affordability. The market did cool off sharply. The very last data point is our data point for the January price index reading, which shows that it was basically flat last month. So this period of price declines has begun to stop, and I'm going to get into that a bit more in a second. So the combination, as I said, of these higher prices and higher mortgage rates, which took off from record low down at 3% or less for fixed rate 30-year mortgages, up over double last year, up over 6% today, bouncing from 6 to 7. That absolutely hurt the ability of homeowners to afford a home. So what I'm tracking here is that share of income it would take to cover the principal and interest on a typical mortgage for someone who bought the typical valued home at that point in time with a 20% down payment. Homes were actually historically affordable in the wake of the housing crash and the Great Recession back in 2012. It got as low as 16% of the median household income to cover that mortgage. It climbed and got less affordable throughout the 20 teens. And then actually early in the pandemic, with the drop in mortgage rates, things got more affordable. There was a window of time in which just through the power of those very, very low interest rates, homeownership became more affordable, down under 20% of a typical income. Then we got the price increases, we got the mortgage rate increases on top of those, and spiked to a record high unaffordability back in October and November of this last year. Well over a third of the typical of the median household income going to that mortgage, which seemed to be a bit of a breaking point for home buyers. It's come back down a bit, but remains even today somewhat higher than at the peak of what we have come to call the housing bubble in 2006. So this is still a major, major problem, even if we've gotten a little bit of relief from the record highs in the fall. So that I called that a breaking point for buyers. One way of looking at that was the sales volume, and what we call newly pending listings is our most real-time metric of how many homes are actually selling in any given week. Those plunged as low as 38% below the same week a year ago, back in November, when mortgage rates peaked. That was a huge decline for anyone whose income is linked to sales transactions in the real estate industry. These looked like very dark times. It looked like the housing market was grinding to a halt. I think people may be surprised to learn is that since that time, as mortgage rates came back down a bit, sales recovered. Now, this whole area is still below 0% year-over-year price change, but that deficit, that gap from 1 year ago, has been cut in half. We've basically climbed back up to where we were in late summer in terms of pending sales volume. And when I look at the first 6 or 7 weeks of the year, it's actually very similar to the sales volume we had in the first 6 or 7 weeks of 2020. So we've kind of come full circle from this crazy frenzied real estate market to a cool down. And now actually we're kind of right back where we started in terms of sales volume and demand, where we were on the eve of the pandemic in 2020. So I mentioned before, kind of the insulation against these super steep price declines was low inventory. Now, this is a chart showing the kind of typical seasonal wave trend that we see for inventory. Up at the top, you can see 2019, the last full normal year in the housing market. There used to be, in any given week, over 1 million homes available for sale. At the moment, there's a little under 600,000, which actually makes this scarcity of homes available for sale identical to the way that 2021 began in the first several weeks. So again, if anyone thought there was a glut of homes or kind of affordability would be solved by all these homes on the market. That's not panning out. And in fact, homes are still very scarce for someone who's out there shopping today. Another way of looking at that is the time on market, how quickly homes sell. This is another kind of seasonal trend comparing several years of that seasonality across the course of a year. In just the last couple of weeks, homes were selling in about 24 days from hitting the market to pending. That's falling fast. That's speeding up dramatically. That's still faster than any start to the year before the pandemic, where I've got these kind of comparisons there. Slower than the last couple of years. The frenzy is not back, but it's still moving very quickly because buyers are not finding that many options out there. So they kind of need to move quickly on the ones they do see. All right, so that's kind of the state of the housing market and of the for sale side of the market. And again, those data points of really low inventory, sales speeding up, that pace of sales going fast, and sales volume picking back up all look to me like some normalization and kind of the end of this major cool down that we had last year. In the rental side of the market, there's a bit of a similar story where in 2021, up through the beginning of last year, we did set record growth for rents. The year-over-year pace was over 15% at times. That has cooled back down, but much like the for sale market, that cool down is kind of ending. We're looking back at a fairly normal start to 2023 in the rental market. All right, so I want to leave it there. If you're interested in this data in particular, check it out at zillow.com/data. And now I want to hand it over to Yelena.
Well, thank you, Jeff. Thanks very much for those insights. And Yelena, you're up.
Thank you so much, Dennis and Jeff. I'm very happy and excited to be here today. I really appreciate the opportunity to speak with you all. I want to build on what Jeff was presenting and add some more focus on the new build market, which is about 15% of the overall housing market in the country, but it's still quite important to the overall economy. So if we can pull up my slides, please. First, I want to focus on the supply side, as that's more what our conversation is talking about today. And as on the next slide, we can see that housing has been underbuilt for many years now. So if we just move over to the first chart there, we can see that housing starts, which is just another word for new home construction, that's the dark blue line there. That has actually been falling for 5 consecutive months. We just got January data yesterday. And now it sits at about 1.3 million new units. And so if you look at this dark blue line, you can see that there was a peak in earlier during COVID times, a little bit earlier last year, and then also the peak coming off of the housing bubble back in the early 2000s. And so when we break out this number, the 1.3 million new units, into the single family component, that's sitting at about 840,000 at the moment, which is way below the 1.2 million peak that we hit in late 2021. Now, back in 2021, we couldn't really go above that 1.2 million simply because of constraints such as shortage of workers, materials, supply chain problems had just started to begin. And we can touch more on that in the Q&A to really discuss what this meant for construction and kind of the speed bump that it created for future home building. And so the construction in the economy is very important to the economy because the current stock of housing needs to be replaced each year. Right now, the median age of an existing home in the country is about 40 years old. And so if you think about it, more than half of the homes in the country were built before 1980. I wasn't around then, but obviously we need to replenish housing stock due to these, aging circumstances. And additionally, housing construction spurs more economic activity. It creates jobs, it creates more demand, and then consumers actually spend more when they purchase a new home or even get a new apartment because they need to fill it with things or get cars to drive them around the new neighborhood. And so that's why we track this so closely. And additionally, we have been saying that housing is actually in a recession over the last little while because the residential investment component of GDP has actually been dragging GDP growth down since the second quarter of 2021. And the last 2 quarters of 2022 were especially low. And so this is kind of why we've been echoing some of the sentiment that others have been saying that housing has been in a recession over the last little while. And now the second thing on this chart is the light blue line, that's the home builder sentiment index. And this is a great leading indicator that we like to look at, because this is where builders think that housing construction is going in the overall economy. And it's really great for understanding overall construction activity that then leads to overall economic growth. And so as you can see in this light blue line, sentiment has actually fallen every month of 2022 and has been in what's considered contractionary territory, below a reading of 50, since August of last year. Now, as you can see in the light blue line, in the last few months, January and February, has actually started to pick back up, even though it's still in contractionary territory. So I'm excited to talk about this more in the Q&A, because could this be the signal of the housing turnaround? Are builders seeing future demand come up? And then that's where we're kind of past that trough, as some have been saying. And so if we move on to the next chart, I just want to discuss quickly the current supply of new homes available for sale. Just on the next slide, please. Thank you. This chart shows the amount of months it would take to clear the current market, the current supply of new homes at the current sales pace. Now, prior to COVID and post-housing bust, that supply level has averaged around 5.8 months, which is very close to about that 6-month mark that's needed to clear the market. Now, COVID hit, more people moved out to the suburbs, exurbs, what we used to call secondary cities. So a lot of building was booming in those regions, especially in the South and in the West. But unfortunately, as I've mentioned, there were a lot of constraints to this boom. And so we can see that a lot of this supply is now sitting longer on the market. And so builders have begun to cool activity so that the single family market is allowed to clear. Now, we think that it will come down closer to that 6-month mark, maybe later this year. Now it's about 9 months. And builders are currently pivoting their activities over to the multifamily sector and to renovations. And so they'll pivot back to single family when more of that supply is cleared out of the market. And now if we move to the next slide, just to drive home the point about this single family building, this showing the amount of single family permits in the country, with January hitting the lowest point since April of 2009, which was post-housing bust. This is another signal that builders are waiting for the drop in demand. They're waiting it out so that it will pick back up again, maybe later this year or next year. And they're focusing more of that renovation multifamily side of construction as they sell off those excess supply of homes. And as you can see here, even at the peak of the COVID era, the permits never even came near the peak of the housing boom. So this is why we always talk about this is not like 2008, 2009. It's very, very different. And so when we move to the next slide, I just want to pivot over to the multifamily sector, because this is quite important for housing supply and affordability. And it actually responds very differently to a rising interest rate environment. Since projects take longer to complete, there's a lag in how the activity is drawn out. And so this sector has actually been booming. Even though permits are down, I don't have permits in this chart, but permits are down for multifamily. The amount of structures currently under construction keeps hitting record highs, but only for the unit structures with 5 units or more, which is that dark blue line here. So it just keeps every month has been hitting a new record high. Some of that being under construction is just a fact of that supply chains are still getting uncoiled, and there's still some restrictions to amount of workers and land that construction workers can find. But really, this is a lot of that for rent market that has been booming due to the fact that rents already increased so much, and so a lot more investment has been pouring into this sector. And a lot of these are actually concentrated in markets such as Nashville, Charlotte, Phoenix, some in Texas and Florida as well. But more importantly, what I really want to focus on with this chart is the light blue line, the construction of buildings of 2 to 4 units, which has been significantly down since the housing bust. We hit a record low back in 2012, and we've never really recovered. We've been flirting with that low ever since. And this is important because in the past generations have been able to buy these units that are going to allow this first-time buyer to enter the market. So this is one of the missing ladders for affordable housing that we so desperately need in the country. And this is the kind of gentle density that could allow urban areas to increase affordability going forward that we haven't really been focusing on. And so just very quickly, I just want to talk about demand on the next slide. And just one more, please. Just quickly talking about demand, because demand obviously stimulates supply and vice versa. And so we can see that first-time buyers, especially those with first-time incomes, affordability was eroded in 2021 and 2022. the few years after the housing bust and in the first year of COVID, as Jeff mentioned, affordability was back in play for first-time buyers. And these are folks who have a lower median income than the national median income. And so as prices went up and mortgage rates also started to go up, more and more homes became less affordable to this type of buyer. And now about 20 or so million are estimated to be completely priced out of the housing market. And I'm talking about the new build and the resale market here, not just the new build market, which tends to be priced higher with a premium. And so we're just moving to the next slide. I want to quickly touch on mortgage rates, because we talk about interest rates, we talk about the Federal Reserve, but really what the Federal Reserve is doing is influencing short-term rates with monetary policy, whereas the 30-year fixed mortgage rate that we tend to look at, the dark blue line, actually tracks the 10-year Treasury bond yield, the light blue line, and that's kind of determined by external forces as well, not just domestic forces. And so when COVID first hit, that gap, you can see more to the left of the chart, the gap between the 10-year and the 30-year actually widened because there's a lot more risk associated with housing. The memories of the housing bust were not far away. But as housing activity picked up and the Fed was buying agency mortgage-backed securities, that gap narrowed in 2021, helping keep mortgage rates lower. But then now rates are doubling, and there's a lot more concern about, homeowners potentially being underwater, even though that's not necessarily the case from the data we've seen. The gap still has widened, and so this is putting that upward pressure on mortgage rates, along with the rising of the 10-year Treasury. And so, if the gap gets narrower, and/or if the 10-year Treasury rate falls, then we can expect the mortgage rate to fall in tandem with it. And just the last slide, I really just wanted to put out our forecast as of this month for the Fed. Yes, they do influence short-term rates, but that does influence overall market conditions. We don't expect them to start cutting, and not to cut until January 2024, and to cut at a very slow pace. So not back to zero anytime soon, barring any sort of external shock, such as more escalations in Russia's invasion of Ukraine, or reopening or reclosing of China again. And so this is our expectation for the Fed funds. And so with that, I really look forward to our discussion. Thank you so much.
Thank you, Yelena. That was really interesting. And again, thank you, Jeff, for your presentation. Listening to you both, I sense a common theme that, and maybe more so with Jeff than you, Yelena, that we're going to experience a springtime thaw during which we will see a rise in housing starts and sales. And I just want to, if you could drill down a little bit, do you both agree with that? And for most Americans, most Americans experienced sticker shock over the past couple of years when it comes to housing. I mean, what does that portend for housing affordability? Why don't we start with you, Jeff?
Sure. Yeah. So we are seeing some strong indications that buyers are making their way back to the market. I think buyers have been responsive to the good news about mortgage rates coming down from those, recent record highs, a record within the last 20 years or so. People were responding to that. And I think also, if we kind of zoom out, the determinants of demand in the medium term are becoming more important. And that is the demographics of, there are millions of extra 30-somethings right now, the core of this millennial generation, many of whom sat out the market over the last couple of years. They were discouraged by high prices, by the multiple offer situations, but they don't want to put off homeownership forever. So as they're kind of coming back into the market, we are seeing those competitive conditions heat up. And because the existing home market is just so tight, there's just so few homes available for sale. That inventory levels like 2021 all over again, I do think that will incentivize home builders to resume their starts and to start to kind of meet some of that demand with that marginal increase in supply. And I think Yelena has a great view on the new home construction market.
Yelena?
Yeah, definitely. I think a spring thaw is definitely possible based on the facts that Jeff just mentioned. For the millennial generation, they have been participating in the labor market at a much higher rate than the overall national number. And then they also have a much lower unemployment rate, which together means that they're a much more solid footing when it comes to their incomes and the ability to potentially even save for a down payment and then afford the monthly payments as well. But unfortunately, there's also a downside to some of these sentiment indicators where, Fannie Mae is asking everyone every month, do folks think now is a good time or a bad time to purchase a home? And the sentiment about it being a bad time to buy is actually up in January to 82% of people think it's a bad time to buy. And so there's a lot of this kind of holding pattern behavior from both buyers and sellers that could very easily stop with more certainty around, the mortgage rate settling at a more of a low 6 or high 5 number. If it continues to trend a little bit lower, more certainty around that, and then more certainty around a Federal Reserve soft landing or a no recession scenario would actually bring more people back from the sidelines. But as Jeff said, the significant supply shortages are going to keep a floor on prices, and so that's going to keep a certain number of folks being unable to participate in the housing market for this year.
Interesting. We're going to talk about that supply problem in a second, but as you know, the national housing market, there's a national housing market, but really is an aggregation of local housing markets. And I was just curious, what local housing markets do you consider the most overvalued and most likely to see significant drops in the short and medium term? And what do those markets have in common? And where do you see, what local markets do you see where prices are going to remain stable and potentially even increase? And what do those local markets have in common? Why don't we start with you, Yelena?
Yeah, definitely. So I think the patterns we've seen over the last few years are the markets that became the hottest go-to work from anywhere markets. So think more in the West and some parts of the South. They're the ones that became the most overvalued the quickest because folks with, tech area salaries, so think someone from the Bay Area moving to Boise, Idaho, has been able to completely outbid any local demand and be able to, offer 100% price bid above asking, and then maybe even offer to name their firstborn after the realtor or whatever those requests were at the time that we were hearing. And so those are the markets that are probably most at risk of cooling the most, simply because they got so overheated. And now with some layoffs in tech, some of that activity is being pulled back. I am noticing more Midwest has been quite flat, not as volatile because it didn't go up as much. Therefore, Midwest markets would not fall as much, and maybe would actually continue to see pretty sustainable year-on-year growth. And net migration, Jeff mentioned this, net migration patterns over the last few years and demographic shifts. Florida, Texas, those are the regions that saw a lot of population increase. So a lot of that demand is going to keep a floor under those prices as well.
Jeff?
Yeah, I'm seeing very similar regional trends where the West is probably still most at risk for continued price declines. In fact, has already seen a lot of declines. Like here in Seattle, we saw the typical home value fall close to 10%, and even further than that in places like San Francisco. Going forward this year, for further declines, I actually kind of think some of these West Coast markets, like Seattle and the Bay Area and Los Angeles, may be kind of insulated because they tend to keep inventory so very low, while the inland West, Yelena mentioned Boise, Spokane, Phoenix, and Las Vegas, kind of more of the desert West, is probably still at the most risk. These are places where there's actually more inventory on the market than there was before the pandemic. That's going to kind of push prices down because those sellers are going to start to accept offers below list price. Meanwhile, it is more of kind of the mid-sized, growing, and somewhat affordable cities back east that I think we'll see the most housing market activity and probably some continued price growth. So both markets kind of like Cincinnati, Columbus, and Indianapolis are all looking quite strong this year. Also markets actually in the Great Lakes region, like Buffalo, for instance, and then some of, as Yelena mentioned, some of those growing markets in the Southeast. So your Charlotte, your Raleigh, your Atlanta, they seem to have very strong economies. They continue to be a draw for migration from places with, colder winter weather.
Well, thank you. I mean, let's talk about the supply problem. I mean, many experts assess that the United States has underbuilt housing by millions of homes over the past 15 years since the Great Recession. What do you see as the major factors contributing to the housing supply shortage? And I assume this supply shortage, this mismatch between supply and demand is causing the housing affordability challenges that we have, and we'd love to get your thoughts. Why have we underbuilt housing for over the past 15 years. Why don't we start with you, Jeff, and then go to Yelena?
Sure. I think the original source of this was how badly builders got burned in 2007 and 2008. They really leveraged up, overextended themselves, put a lot on the line to acquire lots of lots to be building in places where it turned out some of that demand maybe wasn't as organic and reliable. I'm thinking back again to places like Phoenix and Las Vegas that seemed to really overbuild at that time. So builders really got burned, and it wasn't just a problem for the companies, but the millions of people they employed, the subcontractors, the folks working in the trades, the roofers. Those industries were devastated, and many of those workers went out and found new careers. They just went and did something else. And so it has taken a long time for the industry to kind of build back up that productive capacity. And they're still running into supply constraints, both of labor and the parts and the appliances it takes to build homes, the trusses. So a lot of that kind of productive capacity vanished for several years there. I think so a lot of that was kind of geared for the single family homes, going up on greenfield development. The other big thing holding back construction, even in markets where prices remained high and where should have been very profitable to build in the 2010s. I'm thinking of places like Seattle and San Francisco, was really red tape. It was regulations, zoning, very, very long permitting times, so that even in the places where builders were saying, please, I want to build homes for all these people who want them and will pay a fortune for them, we were kind of getting in the way and holding them back. So that really threw a lot of sand in the gears of construction in those places.
Thanks, Jeff. Yelena?
Yeah, I completely agree with what Jeff is saying, and I will just build on the first part about the lack of workers. It's very important to understand that within construction, about a quarter of the total of construction workers in the country are actually immigrants. They're not US born, whereas the national average in overall is about 16%, so much more heavily reliant on immigration. And as we all know, immigration came to a standstill in 2020, but even prior to that, immigration has been slowing. I think we actually hit a peak sometime in 2012 on construction immigration employment. And so to proper immigration policies, that's a federal issue, but a lot of other policies in place are much more localized. Every housing market is different. Every housing market is local. And then just to add another point to Jeff's comments is, the lack of land and also lot size regulations. There's really interesting analysis from the National Association of Home Builders that says that minimum lot sizes, so comparing somewhere like in the South or in the West to somewhere in the Northeast where the minimum lot sizes are much bigger, there's a lot less activity. And then so that need for more density, the smaller lot sizes, no parking minimums, those are all regulations both at the state and local level. But immigration is more of that federal policy that needs a lot more attention.
Interesting. So that's really a multifaceted problem. We have a question from the audience, which I think it refers to your presentation, Yelena, where you show a real growth in the number of multi-family units that are being built. And the question is, are those affordable units or market rate units?
Yeah, excellent question. A lot more focus actually since the housing bust has been on that market rate, especially on the Class A, simply because that's where the margins are. It's very hard for builders to find margins, especially in the rising cost environment and rising cost of workers and materials. And so there's a lot more of that focus, but almost every apartment now is advertised as luxury. It's just considered Class A apartments. So there's definitely more focus on there. But you're right, the need for affordable apartments is definitely very high.
But the need's there, but they don't pencil out for developers to build rental units for lower income households or moderate income households. Often a subsidy is needed to make sure that the economics work on the deal. Do you agree with that assessment, both of you, Jeff and Yelena?
Yeah, absolutely. And I do think those regulations play a big role where some of the multifamily form types, including those 2 to 4 unit small buildings, the 4-unit park under dingbat that was popular in Los Angeles in the 1970s. they're no longer often legal to build these low cost, very simple construction method apartment buildings. And so instead, the only folks who can kind of navigate the regulatory system and build these huge parking structures necessary to meet the minimums are going to be builders who can go pour, 1 million yards of concrete, put up steel girders, and get these impressive Class A luxury apartment buildings. But in many ways, that's kind of the only thing you can build in this environment. And so certainly there's a huge role to play for more subsidy as well as targeted relaxation of regulations to make sure that even when the money is there, that it's actually legal to build these types of homes that will be affordable for renters.
Mhm. Thank you. Did you want to add anything, Yelena?
No, that's very well said. I completely agree.
Great. Let's talk about the demand side. You both mentioned this, but let's drill down a little bit deeper. In recent years, as you pointed out, a record number of millennials are reaching home ownership age, and older adults increasingly want to age in place. And I saw a statistic that now 16% of the population in the US is now age 65 or older. And then, of course, remote work life seems here to stay. And these dynamics seem to be producing a bigger population or demographic group of people in need of housing. So explain these demand pressures and how that's interacting with a constrained supply situation.
I can start there. I think,
Sure.
Those comments are very accurate in terms of kind of what our demographics are looking like. But when you think about, the different analyses that certain groups do on how much we're underbuilt, right? There's certain numbers being thrown out, like 4 or 5 million underbuilt in the country. Others are saying only about 1.5 million. And that's based on what kind of analysis they're doing. Are they saying it's the current to medium term constraints, which is what you just mentioned, which is, yes, much more in line with that 4 to 5 million number. But if you think longer term, Gen Z is actually a smaller generation than millennials. And unfortunately, baby boomers will get older and will start to be reduced in number. That's just natural aging. But really, for the longer term, we are still, before COVID hit, we were dealing with an aging demographic with low interest rates, with much more savings in the economy. Are we going to return to this kind of slower growth, slower momentum environment once all these COVID pressures, all these supply shocks finally get worked out? I don't know the answer for that. I'm not a demographer, but really, I think for the short to medium term, probably around 2 or 3 million is more accurate to say what we're underbuilt in the economy. But for the longer term, there is always a risk that we will be oversupplied like we were back in the housing bubble, but we're nowhere near that phase yet. So be happy to hear what Jeff thinks in response to that.
Yeah, I think it's difficult to kind of answer this question of how many occupied homes would there be if we just had housing abundance. I've attempted one analysis of this where I found over 5 million more homes, sort of more households would exist if people were able to form their own households at the same rate they did in 2006, which was sort of a high water mark for headship, meaning the propensity to be your own household head for different age groups. So that's something I keep in mind of sort of what the underbuilding means for folks is just more of those 20-somethings who have to move back in with their parents, maybe more of those 30-year-old couples who are still splitting the rent with their friend Jerry because they can't afford to buy a place of their own. So there are all these little ways in which people's aspirations for the American dream of a place of their own, whether to rent or own it, are crimped by just not having enough homes around. That's the mechanism for that is the price. But at the end of the day, what it means is, people kind of cramped up a bit more together. And in many of those cases, especially for younger folks, putting off those important life milestones, moving out from their folks, getting married, getting a place of their own. So this is a really tough time where we have the two most populous generations ever, the baby boomers and millennials, now are both in these age ranges, sort of the 30s to early 40s, and then up in the 60s and 70s, where people tend to want a place of their own. People tend to want to be homeowners, and we just don't really have enough homes built in preparation for this big demographic crunch at the moment.
Thank you for that. My hunch is that many people do not appreciate the deep connection between the rental and home ownership components of the U.S. housing market. I was wondering, can you share some thoughts on this connection and how do they interact with each other? Why don't we start with you, Jeff, and then go to Yelena.
Sure. So, demand for both rental and owner-occupied housing is coming from the same place. It's coming from those demographics, how many folks there are who want a place of their own, and the economy, which is going to dictate how much they can afford to spend on a place of their own. So when the economy was booming, disposable personal income was rising quickly, unemployment was falling quickly in 2021, that helped trigger a boom in demand for both owner-occupied and rental-occupied housing. There are some subtleties here as well, because these are also competing products that people choose between. So, when mortgage rates rise, that's going to make home ownership a little less attractive for some of those, those 30-somethings thinking about buying their first home. But in many ways, it's some of the same root forces of consumer confidence and employment and income that give everyone that people rely on to have that confidence to go buy a house or go sign a 12-month lease. I think both of those were, folks were facing a lot of headwinds in the fourth quarter, in the third quarter of last year. It does seem like as people are feeling more confident and the economy seems surprisingly resilient this year, that demand for both may begin to kind of open back up.
Yelena?
Yeah, I agree with Jeff completely. I think there's a lot of misconception around this idea that, if mortgage rates go up or if the housing market for single family homes kind of kicks out a lot of folks from participating, then that means the rental market will be booming. Well, not so much the case, because the question is all about, household formation. And as Jeff said, are you going to stay with a roommate longer? Are you going to stay at your parents longer? Are you going to consider moving somewhere else? And so that activity gets completely paused in times of high uncertainty, rising unemployment, rising inflation, higher costs, especially for folks who are able to lock in maybe lower mortgage rates. They are just sitting put. They are not even considering, unless they absolutely have to due to some sort of life event, they're not considering moving right now. And then, the question about renewing a lease versus finding a new lease, depending on what kind of market you're in, you might find more concessions. But, again, like they do tend to move more similarly than in opposite. And so this idea that when one is struggling, the other is booming, that's not necessarily what we've seen in the data. And that's not what we're seeing right now.
Okay, great. We got a question from the audience. In a Washington Post article about cash buyers, Lawrence Yun from the National Association of Realtors, another economist, commented that, quote, essentially only the wealthy are buying homes right now. Do you agree with this characterization or disagree? And who is buying homes right now? And how are they responding to the high mortgage rates?
I could jump in. I think that's an overstatement. I don't think it's only the wealthy or only cash buyers. In fact, we are still seeing a lot of competition, particularly on the lower priced tier in different markets, the more affordable homes, in part because some of those folks who may have been targeting the median priced home, now they're determined to buy a home. And so when they run the numbers with today's mortgage rates, they go and say, okay, I need to maybe buy a townhouse that's $100,000 less expensive. Certainly between cash and financed buyers, these higher mortgage rates are tilting the playing field a bit. They are shrinking that purchasing power of financed buyers and sort of further building the advantage of a cash buyer in a market like today's.
Mm-hmm.
Yeah, I would agree. And I think it's also your interpretation of what is wealthy. So if you're already a homeowner and you've seen enormous growth in equity in your current home, and you want to potentially sell that and use that as a down payment for your next home, then yes, you probably have a lot more strong footing than a first-time buyer that would need only to put 5% down, and especially in such a rising interest rate environment. So I think it's much more complicated than that summary that the statement gave. But of course, we are seeing much more all cash purchases right now compared to financing.
Thank you. We're about out of time. I'm going to give you a final question. As highly trained economists who are obvious experts on the housing market, what keeps you up at night? What do you worry about?
I can kick off, especially because it's all related to housing in the general economy, is the significant fall in labor force participation from every recession. Really, it's just a structural component of the economy. But especially when we think about prime age labor force participation, the 25 to 54-year-olds that we need to really boost labor activity and then other activity in the economy. Women's labor force participation in the US is about 12 percentage points lower than Canada's. That's a lot of policy concerns right there. So policy that's good for the housing market is actually also good for the labor market as well. And so I really think about that.
Interesting. Jeff?
At the moment, what really keeps me up is the possibility of a default on government debt coming up this summer, running into the debt ceiling and not averting disaster for the debt markets. I think nobody has a very good grasp of exactly how wide-reaching those implications could be. I think it will certainly push up yields, it will push up mortgage rates, and just cause a lot of disruption, both in the housing market, all around the economy. And in some ways, the fact that we don't know how bad it could be is all the more reason to kind of take a precautionary principle and make sure we don't ever open that box.
Thanks for that. I just put a plug in for the Bipartisan Policy Center. We do a lot of work on the issue of the debt ceiling and the X date when we might fall off the cliff. Hopefully not. But I just want to thank both of you, Jeff and Yelena, for your important insights and contributions today. We're out of time, unfortunately. I also want to thank everyone in our virtual audience for tuning in. The BPC's next housing event will take place on March 14th, when we will hear from USDA Undersecretary Xochitl Torres-Small on the unique housing challenges confronting rural America. So please go to the BPC website at www.bipartisanpolicy.org to learn more details. And with that, I want to again thank our guests, Jeff Tucker and Yelena Maleyev, and thank the audience for tuning in today, and have a great weekend.
Thank you.
Thank you.